Bear markets can be particularly nerve-wracking as you watch helplessly while your portfolio slowly declines in value. But why exactly should you be wary of buying in a bear market? Watch this video till the end to learn more about the bear market. Hey guys, and welcome back to another fascinating episode of Cody Currency. Today in this video, we will be talking about why are investors wary of buying in a bear market. But before we move forward, don't forget to smash the thumbs up. Also, make sure to subscribe to our channel and turn on the post notification not to miss out the future crypto updates. Many investors are spooked when they hear the words bear market. But unlike the duration of bull markets, when the market is gaining in value, these profound market downturns are unavoidable and frequently quite brief. So, what exactly is a bear market? A bear market is a sustained decline in investment prices, usually by 20% or more from their most recent high. Individual companies, as well as markets as a whole, such as the Dow Jones Industrial Average or the S&P 500, can experience bear markets. While 20% is the cutoff, bear markets frequently fall considerably more than the overtime, rather than all at once. Despite occasional relief rallies here and there, the market is still trending downhill. Investors eventually begin to identify reasonably priced equities and begin buying, bringing the bear market to a close. Now, we will tell you an important thing, that is what to do in a bear market. Severe bear markets may cause financial catastrophe. Salary cutbacks, reductions, and payment delays are all possible outcomes of economic downturns. It's wiser to prepare for a stuttering economy than diving into investing in a bear market. Make a buffer and a contingency fund to meet costs for the next 6 months. This will save you money in the event of an emergency and prevent you from having to use your retirement funds. Bear markets are also an excellent opportunity to re-evaluate your risk tolerance. Some investors prefer to wait until the bear market has passed before investing. Investors frequently realize they have missed the bus once the market has completely recovered. You will fall behind the longer you wait. So, enter the market in stages, but make sure you have adequate cash on hand. It is critical to have a financial plan in place in order to make educated decisions. You are more inclined to make impulsive judgments during market turbulence if you don't have a strategy. Now, we all know bear market gives a heart attack to the investors and bring money problems to every household. But investing during a bear market is a bright choice. So, here we will explain to you how to invest in a bear market. Following are some investment recommendations for a bear market. Hold tightly onto it. If you believe in a firm, you should stick with it no matter how much its stock price drops. If you require cash, you should consider selling. You should also examine your portfolio to see whether trading in the company's shares is smart. It is preferable to avoid jeopardizing your objectives by liquidating long-term investments. Invest in stocks. During a bear market, all firms' stock prices decline. It is said to be the optimum moment to invest and purchase stocks. However, you should invest in stocks of solid firms that are expected to grow in the future. Rebalance your portfolio by focusing on value equities rather than growth firms. Take a long-term perspective. Take a long-term perspective because it's impossible to forecast how long the bear market will endure. It is doubtful that the equities you acquire will generate returns within a year. As a result, take a long-term perspective and invest in equities that you want to retain for a long time. Investing in dividend stocks during down markets is a great opportunity to find firms with a history of paying out big dividends. Dividends are a fantastic method to earn a consistent income. It would also enable you to reinvest the dividends you get. Do not, however, overlook high-growth firms in favor of dividend stocks. When prices fall, it's the best time to invest in those high-growth stocks you've been eyeing. Timing the market. Most investors flee the market and sell their investments during a bear market. Marketing volatility is unavoidable, and while the dip causes investors to fear, try to time the market is a fool's errand. The best strategy is to ride out the storm during a bad market. Bear runs don't last indefinitely. As a result, being patient with your investments will pay off. Do not sell your investments if you are in a rush. Keep an eye on company growth and keep shares for a longer period of time. It's a terrific moment to get into the market if you are a novice investor. However, make sure you invest in high-quality stocks. What drives a bear market and how long do they last? A bear market often happens immediately before or just after the economy enters a recession. Investors pay close watch to important economic indicators such as hiring, wage increase, inflation, and interest rates to decide if the economy is stalling. Some of the signs were various in the instance of the COVID-19 pandemic. Widespread closures, an increase in jobless claims, and social distancing measures were just a few of the warning signs that the economy was in crisis. Investors expect business earnings to fall in the near future as the economy is contracting. As a consequence, they sell equities, forcing the market to fall. A bear market may indicate higher unemployment and more challenging economic possibilities ahead. Bear markets are often briefer than bull markets, lasting 363 days on average versus 1,742 days on average. According to data collected by Invesco, they are also statistically less intense, with average losses of 33% compared to bull average market profits of 159%. The coronavirus bear market, formed on March 11, 2020, quickly transitioned to a bull market, while the virus's entire economic impact has yet to be discovered. Now let us look at the phases of a bear market. Phases of a bear market. Bear markets normally go through 4 stages. Number 1. High pricing and positive investor optimism define the first phase. Investors begin to exit the markets and grab profits at the end of this period. Number 2. In the second phase, stock prices begin to fall significantly. Trading activity and corporate earnings begin to decline, and previously optimistic economic indicators begin to deteriorate. As investor mood begins to deteriorate, some investors become panicked. Capitulation is the term for this. Number 3. Speculators begin to enter the market in the third phase, causing certain prices and trading volumes to rise. Number 4. Stock prices continue to fall in the fourth and final phase, albeit at a slower pace. Bear markets are giving way to bull markets as cheap prices and positive news re-attract investors. Lastly, let us look at some past examples of a bear market. In October 2007, the stock market was caught up in the escalating house mortgage default crisis. On October 9, 2007, the S&P 500 reached a high of 1,565.15.9 as the breadth and effects of house mortgage defaults on the wider economy became obvious, and it plummeted to 682.55 by March 5, 2009. On December 24, 2018, the major market indexes in the United States came dangerously close to entering the bear market territory, coming just short of a 20% decline. On March 11, 2020, the Dow Jones Industrial Average entered a bear market, while the S&P 500 entered a bear market on March 12, 2020. This came after the index's longest bull market in history, which began in March 2009. The outbreak of the COVID-19 pandemic, which brought mass lockdowns and the prospect of diminished consumer demand, drove stocks lower. The Dow Jones plummeted quickly from all-time highs above 30,000 to lows below 19,000 in a couple of weeks during this time. The S&P 500 fell 34% from February 19th to March 23rd. Other instances include the aftermath of the dot-com bubble explosion in March 2000, which wiped off almost 49% of the S&P 500's value and lasted until October 2002. The Great Depression began on October 29th, 1929 with the stock market crash. So guys, that have been for the day. Hope the video was informative. What did you do during the bear market? Have you succeeded? What lessons did you learn? Tell us about your views and opinions in the comment box below. Before we say our goodbyes, don't forget to smash the thumbs up. Also, make sure to subscribe to our channel and turn on the post notifications not to miss out on future updates. Until the next video, goodbye.